Good morning. We welcome you all to Ignitis Group results call for the first 9 months of 2021. I'm Ignitis Group, Investor Relations Officer at Ignitis Group, and today it's my pleasure to host this call. With me, we're also having Ignitis Group CEO Darius Maikštėnas, CFO Darius Kašauskas, and Head of Corporate Finance Jonas Rimavičius. The group's management today will present the most recent business highlights, financial performance, and guidance for 2021. Afterwards, we encourage you to participate in the Q&A session. So with that, Darius Maikštėnas, please begin.
Good morning. Despite unprecedented energy sector dynamics, regulatory and corporate governance updates, we had a successful 3 quarters of 2021. Overall, our adjusted EBITDA grew by 31% to 214.5 million euros compared to 9 months of 2020. While all business segments contributed to the group's growth, green generation business segment continues to be imperative factor. Specifically, our results were driven by installed capacity expansion in green generation business segment, improved results of customers and solutions segments due to temporary positive impact of favorable changes in natural gas market prices, and higher distributed volumes in network segment, which will level off during the year. With these developments in mind, we reiterate our 2021 adjusted EBITDA guidance of 300 to 310 million euros. In terms of shareholder returns, we paid 43.75 million euros in dividends, or dividend per share of 0.589 euros per share for the first half of 2021, which is in line with our dividend policy. Turning to regulatory environment, we managed to ensure a sustainable regulatory framework through newly established additional tariff component, which offsets the change in RAB calculation method. From now on, we have a full clarity on the next electricity regulatory period. Turning to key developments in green generation business segment, on the whole, we are getting closer to our 2024 targets. Notably, in 9 months of 2021, we increased installed capacity by 19 megawatts as the result of COD of Vilnius CHP waste-to-energy unit. Additionally, we expanded our pipeline by additional up to 240 megawatts as the result of 2 conditional acquisitions. First is 3 wind farm development projects of 160 megawatts in Latvia and up to 80 megawatt solar development portfolio in Poland. All remaining projects are fully on track with exceptions of Pomerania wind farm and Polish solar portfolio 1. In Pomerania wind farm, we are experiencing around 8-month COD delay from quarter 1st of 2021. That is due COVID-19 and other typical development project risks. On the Polish solar portfolio 1, we continue agreement renegotiations with Sun Investment Group, as now CFD tariffs has been awarded in the last 2 auctions. Additionally, in Q2 2021, we announced the agreement with infrastructure supplier for approximately 1.2 million of smart meters. On that point, to comply all high-level requirements, including cybersecurity related, rollout has been pushed to 2025 for smart meters from 2023. However, it's important to note that while the project is on track, potential disruption in supply chain around the world could potentially cause some delays in smart meters deliveries. Finally, turning attention to sustainability and governance, we continue to elevate our ESG profile and receive recognition as the result. Most recently, our greenhouse gas emission reduction targets were approved by SBTi. Additionally, we received an ESG risk rating upgrade from MSCI from A to AA, placing us among the industry leaders and significantly above the utility group average of BBB. On corporate governance side, we have new supervisory board comprising 7 members, 5 independent members, including the chair, and 2 representatives of a majority shareholder. And finally, a selection process for a new term of the management board has been initiated. A definite ESG highlight so far this year is that we will have emissions by 2030 in line with SBTi requirements. Our near-term targets, which cover all 3 scopes, are aligned with 1.5 Celsius scenarios alongside an explicit net zero by 2050 commitment. We commit to reduce greenhouse gas emissions by 47% by 2030 compared to the 2020 baseline, and to reach net zero emissions by 2050. To do that, we will endeavor to engage our partners, suppliers, and customers in the process to ensure the sustainable future. Turning to segment performance and networks, we continue to showcase solid growth as we recorded 16.6% adjusted EBITDA growth in 9 months of 2021 compared to the same period last year. Worth to note that this result was adjusted for recent electricity business line regulatory changes, which we will cover again in the next slide. Such performance was largely driven by higher distributed volumes and higher income from new customer connections and upgrades. It is important to note that higher distributed volumes effect will level off over the course of the year. In terms of investments, CapEx levels also increased compared to the same period last year, mainly as the result of high investments in maintenance of the electricity and gas distribution network. During the last quarter, as already mentioned, we concluded an agreement with a infrastructure supplier for approximately 1.2 million of smart meters to be installed by the end of 2025. It's important again to cover recent regulatory changes affecting our network business. As mentioned in ERC, our regulator updated methodology for determining the price caps for electricity network. Key change here is that RAB calculation method was changed from RIC to similar to historical cost model. Fortunately, sustainable regulatory framework was ensured through the newly established additional tariff component, which offsets the change in RAB calculation method. That said, these changes did not affect our outlook, and we are continue to reiterate our group adjusted EBITDA guidance for 2021 and 2024 targets, dividend policy, and investments. Turning to green generation business segment, performance was in large affected by installed capacity increase and higher electricity prices. This is demonstrated robust adjusted EBITDA growth of 64.5% compared to 9 months of 2020, which was supported by positive impact of Kaunas CHP and Vilnius CHP waste-to-energy units. Plants to be launched in August 2020 and March 2021. As well, better results of Kaunas HPP due to the higher captured electricity prices. On that point, while our installed capacity increased by 19 megawatts compared to 9 months of 2020, our investment levels in 9 months of 2021 were reduced by 89.7%, down to 18.3 million euros, mainly as a result of completion of major projects, such as Kaunas CHP, Vilnius CHP waste-to-energy units, and Pomerania wind farm. In terms of green generation pipeline, as mentioned, in 9 months of 2021, we expanded our pipeline by up to 240 megawatts as a result of the conditional acquisitions of 3 early-stage wind farm development projects in Latvia, up to 80 megawatt solar development portfolio in Poland. Both projects will contribute to our 2024 green generation installed capacity target. While all remaining projects are fully on track, we do have a couple of speed bumps with Pomerania and Polish Solar Portfolio 1, as mentioned before. Turning attention to auxiliary business segments and flexible generation, we have showcased positive adjusted EBITDA growth compared to 9 months 2020. This was largely as the result of higher clean spark spread, which led to margin for CCGT unit commercial activities. That said, electricity generation was slightly down compared to 9 months of 2020, as less favored days for generation resulted in lower volumes of CCGT commercial activities. As for customers and solutions segment, our adjusted EBITDA has also increased in 9 months compared to the same period of last year. The growth was supported by temporary positive effect of natural gas performance as the result of natural gas inventory revaluation due to increasing prices, which is expected to reverse in 2022 if natural gas prices normalize. However, it was partly offset by decrease in natural gas B2B and natural gas export due to the lower sales volumes. Additionally, we maintained leadership in total B2C, 86%, as well as independent supply, 63% market shares by volume, despite B2C electricity market deregulation activities. However, that has also partially caused a decrease in NPS. Finally, updated LNG cargo supply agreement terms with Equinor, and recently the government confirmed the same mandatory supply volume for LNG terminal amounting to 4 cargoes per year for 2022 and down to 2024, reducing the uncertainty of designated supplier activities. During a roller coaster of wholesale electricity and natural gas prices, governments looked for mechanism to ease the increase in prices for customers. In Lithuania, the amortization mechanism was set in place to soften this issue, which we believe is fair. So the group will amortize the increase in energy prices for which additional working capital may be required. Following that, amortized amounts will be returned to the company through the regulated tariffs, including interest, over 2023 up to 2027. As a result, there will be no effect on P&L, only cash flow, as illustrated by the graph. With that, I give the floor to CFO Darius Kašauskas to cover 9 months of 2021 financials.
Thank you, Darius. I'm pleased to present financial highlights. Just before we begin in our financial performance, I would like again to draw attention due to the network methodology update, All adjusted financial indicators were calculated retrospectively for the year 2020. And as Darius already mentioned, we progressed well in 9 months 2021, which is also reflected in our financial results. In terms of adjusted EBITDA, we delivered 31% growth, reaching almost 215 million euros, mostly as a result of launch of Kaunas CHP and Vilnius CHP waste-to-energy unit, and better results from Kaunas hydropower plant. Also, temporary positive impact of favorable changes in natural gas market prices in customer and solution business segment, and higher distributed volumes effect in network business segment, which will level off during the year. As a result of high adjusted EBITDA, our adjusted net profit number was also attractive, recording more than 65% growth compared to the same period last year and reaching almost 84 million euros. Dissecting our adjusted EBITDA number, we can see that green generation and network segments we are the largest contributors to the overall adjusted EBITDA level. Specifically, green generation added more than 21 million euros to overall level, while networks contributed another 18 million euros. Meanwhile, flexible generation delivered the smallest adjusted EBITDA contribution, adding 1 million euros. Turning to returns, on adjusted return on capital employed number also showcased growth in 9 months 2021, reaching 6.8%. The increase compared to 9 months 2020 was mainly driven by increased adjusted EBIT for last 12 months. In turn, adjusted EBIT was driven by high adjusted EBITDA LTM, which was partly offset by higher D&A expenses. Looking at the right side, our adjusted ROE has also increased by 1.2 percentage point to 7.4%. This was driven by increased adjusted net profit LTM, which was partly offset by increase of capital during the IPO in Q4 2020. Our investments in 9 months 2021 decreased by more than 51% to 131 million euros compared to 9 months 2020, as major projects were near completion or already completed, including Pomerania Wind Farm, Kaunas CHP, and Vilnius CHP waste-to-energy unit. Investments in network segment grew by 17 million euros compared to last year as a result of high investments in maintenance of electricity distribution network, which were partly offset by lower investments in expansion of gas distribution network due to less new connection points and upgrades. Looking at our free cash flow and net debt numbers, our free cash flow decreased by 45% as a result of increased change in net working capital, which was mainly driven by increase in gas inventory as price go up, as well as LNG cargo received in September 2021. And growth of natural gas and electricity derivative trading deposits due to higher market prices. Meanwhile, our net debt decreased by 3.3% due to dividends paid, also partly offset by positive free cash flow. And finally, looking at net debt bridge, high FFO continues to be the largest driver of net debt reduction in 9 months 2021. All for investments, dividends, and change in net working capital, we are considerably dragged to our net debt in 9 months 2021. First, our net debt to adjusted EBITDA has decreased from 2.5 times to 2.1 times, while FFO to net debt metric decreased from 52% to 51%. With that, I give the floor back to Darius Maikštėnas to conclude presentation.
Thank you, Darius. As a result of a really solid 9 months performance, we reiterate our 2021 adjusted EBITDA guidance of 300 to 310 million euros. Our confidence is the guidance is the mostly driven by green generation installed capacity additions, increase in Kaunas HPP result due to higher electricity market prices, and increase in customers and solutions result due to the natural gas inventory revaluation driven by increasing natural gas prices. To conclude this presentation, let me leave you with the following key messages. First and foremost, we have showcased resilient performance in 9 months of 2021. Our adjusted EBITDA grew across all segments, mainly driven by green generation installed capacity increase. This allowed us to reiterate our adjusted EBITDA outlook of 300 up to 310 million euros. Additionally, we paid 43.75 million euros in dividends for the first half of 2021, which is in line with our dividend policy. Further increased our green generation pipeline by up to 240 megawatts as the result of 2 development project acquisitions signed in Latvia and Poland. We also now have full clarity of next networks electricity regulatory period. Despite changes, sustainable regulatory framework maintained. And finally, we received ESG risk rating upgrade from MSCI from A to AA, placing us among the industry leaders and significantly above the utility group average of BBB. And our greenhouse gas emission reduction targets, covering all 3 scopes, have been validated by SBTi. By 2030, we target to decrease the emissions almost by half. By that, right now we are ready for the questions.
Thank you, sir. We will now begin the question and answer session. If you wish to ask a question via the audio, please press star and 1 on your telephone keypad and wait for a name to be announced. To cancel your request, please press the hash key. Alternatively, please use the ask a question box available on your webcast page to submit your questions. Dear participants, once again, if you wish to ask a question over the phone, please press star and 1 on your telephone keypad. Alternatively, you're more welcome to submit questions via the webcast.
Currently, as we have no questions on the line, we can begin with the ones received by written. So the first question we received is as following. During 2021, negative effect in regulated activities is driven by higher than tariff electricity and natural gas market price. Does adjusted EBITDA results account for aforementioned effects? In other words, does the accumulated loss on paper, which will later be compensated through the amortization period, from regulated activities decrease current adjusted EBITDA on a monthly basis? If yes, does that mean that from 2022 amortization amount, approximately amounting to 40 million euros from regulated electricity supply activities, will have a positive effect on adjusted EBITDA and profit?
Yeah. So, in short, the price differences between electricity and gas market price levels and those included in the tariff do not affect the adjusted EBITDA and adjusted net profit. There are two reasons why is that. So first is that the updated regulation allows to accrue most of the differences as a receivable on the balance sheet. Therefore, the effect does not go through P&L. And second is that the remaining differences are eliminated from adjusted EBITDA through management adjustment. And it goes both ways. So when the market prices are higher than tariff, we eliminate the negative impact. And then when the tariff is higher than the market prices, we eliminate the positive impact. So, and this is the same for electricity and gas supply. So all in all, differences between the market prices and the prices set in the tariff don't have an impact on adjusted EBITDA nor on the adjusted net profit.
Thank you. Our next question is, what is the approximate share of independent electricity supply clients that have fixed longer-term contracts, for example, 12, 24 months? Are such contracts hedged against market price fluctuations? If not, does that mean that they are currently unprofitable for Ignitis, and in near future, when the contracts expire, they will be recalculated with higher electricity price, thus eliminating negative effects for financial results?
Okay, so around 70% of our independent supply contracts are fixed, and nearly all of them are fixed for at least 12-month period. Every such contract, every fixed contract that has been sold is hedged. However, we must note that since there is a low liquidity of hedging derivatives in the Baltics, part of the prices is hedged indirectly through proxy hedges. And these proxy hedges might not be, perfect hedges. So there might be a negative result coming out of inefficiency in hedging because of low correlation. And for example, this year, such event happened, and we had a negative impact of around 1.5 million euros. So this is not something which is material on the group level, but still should be taken into account. When these contracts expire, their price will be recalculated according to the relevant market situation, and they will be hedged accordingly as well.
The next question is on green generation projects. What share of Polish solar portfolio of 80 megawatts can we expect to start commercial operations in the next year? What is the expected impact on EBITDA in 2022 and overall, when the whole portfolio starts commercial operations?
Okay, so in 2022, we expect only the minority of these 80 megawatts to start operations, and the majority should come in 2023. In terms of expected EBITDA level, it will depend on actual megawatts built and on the tariffs obtained by the developer. In any case, the returns will be within our target range of high single to low double-digit levered equity returns.
Thank you. The next question is, what is the current situation with 170 megawatt Polish solar portfolio 1? Is there any progress? Perhaps the project will be cancelled?
So at this stage, we continue agreement renegotiations with the developer. as disclosed previously. And currently there is no further update, but as always, we will disclose it once the situation is clear.
One more question for green generation projects. What is the current stage of Vilnius CHP biomass unit? Is it still expected to commence commercial operations in Q4 2022?
So the current status is that the completion level is around 75%, and we expect that the first heat will be produced around Q4 2022.
The next question is it possible to develop and operate offshore wind park with current technologies or near-term technologies to earn sufficient returns? Does Ignitis see opportunities in such a way to develop Lithuania's first 700 megawatt offshore wind park?
We think it's unlikely to develop first Lithuanian offshore project without any subsidies. However, it could be possible to have subsidies not for all electricity generated by offshore project, but only part of it.
Thank you, Darius. Our next question is, in the strategic plan 2021-24, it is stated that in 2024, Ignitis will have 1.8 to 2 gigawatt of green generation capacity. Is it still possible to achieve this target?
Yes, it is possible to reach our green generation installed capacity of 1.8 to 2 gigawatt target in 2024, and we are sticking to this target in place.
Our next question is, could you explain current situation regarding Pomerania Wind Park? Is it already contributing to monthly announced EBITDA results? Is it still producing electricity at market price? Is it working at full installed power?
Yes. So in terms of Pomerania, it is currently generating electricity. However, because it has not yet received the generation license, because of processing of documents on the regulator side in Poland, the results from wind farm are not reflected in the reported figures. However, in order to reflect the actual result, we include it in our EBITDA adjustments. Therefore, it is shown in the monthly adjusted EBITDA results.
We have a few questions on offshore wind projects. You present an investment. Apologies for that. You present investments to Lithuania offshore wind power plant as if you had already won the right to build it. Since the project is planned for 700 megawatt and constitutes a large amount of your future plans, what are your alternatives if another company wins the right to implement this project?
Thank you. So this project, as you know, the tender is planned for 2023-2024. So the actual development will start after that. For us, it's an important project, but not alone. And we have significant pipeline in the process, and we are not sticking to only this offshore project as well. So to reach 4 gigawatts by 2030, we are quite confident that we will be able to develop such amount, including all technologies, offshore, onshore, and solar.
Thank you. Another question is, thus far, Ignitis only stated its intention to participate in Lithuania's offshore wind park project. Is it possible that Ignitis will participate in similar projects in other home markets, Baltic countries and Poland?
Yes, it's possible.
Thank you, Darius. Our next question is, When can we expect to see first cash outflows as payments for recent acquired assets in Poland and Latvia?
Okay. It depends. For the Polish project, the cash outflows for investments will go out already next year because we expect the first projects to reach COD already next year. In terms of the Latvian projects, since we expect COD around 2026, the major amounts are likely to start in 24-25.
Thank you, Jonas. Our next question is, can you provide some guidance in relation to the potential size of amortization expected in 2021, 2022?
Yeah. Overall, our base case scenario is that it should be around within 200 million euro range. However, it will depend on the actual changes in the wholesale electricity and natural gas market prices.
Our last question I received in written. Hello. What do you see as the main drivers of EBITDA development for 2022?
As our strategy remains the same, main drivers for the further growth are in green generation, new capacities, as well as we are continuing some investments into the networks that will be reflected as well.
Thank you, Darius. As we have no further questions, operator, could you please advise, do you have any on the line?
Thank you. At this moment, we do not have any questions over the phone, but I just would like to give a reminder, dear participants, if you wish to ask a question over the phone, please press star and one on your telephone keypad. Dear participants, once again, if you wish to ask a question over the phone, please press star and one. Alternatively, you're more welcome to add your questions on the webcast.
We have received one more question in written. As a follow-up, the 200 million range for amortization, is that annual amount expected in each of 2021 and 2022?
No, this is a total amount for both years, for both electricity and gas.
Thank you. We received just one more question. When do you plan the share buyback?
The share buyback is planned still this year, so we will update on the next steps for announcements as usual.
Another question. What is proportion of GDRs versus share in the percentage form?
Currently, we see that GDR share is less than 50%.
Dear participants, as a reminder, if you wish to ask a question over the phone, please press star and one on your telephone keypad. Alternatively, please use the Ask a Question box on the webcast. Dear speakers, there are no further questions over the phone.
Thank you. So this now concludes our earnings call. Thank you all again for joining us today. And should you have any questions, please do not hesitate to contact Investor Relations team. So thank you and stay safe.